Great. As Tom said, my name is Carolyn Cumby. I'm one of the ERISA attorneys with Definity. Thank you so much for being here. Good afternoon, good morning, depending on where you are. I'm located in a suburb of Chicago, so it's afternoon for me. But today I'm going to talk about Secure Act tax credits. Hopefully this is some information that you can relay to your clients as some more incentive for putting in a plan. So first, the Secure Act, which I'm sure you've heard about ad nauseum. It is Setting Every Community Up for Retirement Enhancement Act. It was signed into law on December 20th, 2019. Most of the provisions are effective for the plan years beginning on or after January 1st, 2020. And this is the most significant piece of pension legislation since the Pension Protection Act of 2006. It had a lot of changes, a lot of various areas in the retirement plan industry. And so the tax credits are what we're going to talk about today. So there are two specific credits we're going to talk about. The first is the Qualified Startup Cost Tax Credit. This allows an eligible small business to claim a tax credit for adopting a new 401k plan. That's under Section 45E, as well as a tax credit for a eligible small business to claim a tax credit for a new automatic enrollment feature. The eligibility provisions for the small business are similar for both, but not exactly the same, and we'll cover those. When combined, these credits can total up to $5,500 per year or up to $16,500 over a 3-year period. So first, the startup cost tax credit. What is an eligible small business? There are 3 requirements in order to be eligible for this tax credit. First is they have to have 100 or fewer employees who were paid at least $5,000 in compensation by the employer in the preceding year. Now, this plan has to cover at least one non-highly compensated employee with the retirement plan, as well as in the 3 tax years before the first year the employer is eligible for the credit. The employees weren't substantially the same employees who received contributions or accrued benefits in another retirement plan sponsored by the employer. So this is a consideration for you have to consider qualified plans, SEPs, and simple plans. So the other thing you need to consider is related entities. So you have to consider control groups as well as affiliated service group members. Further, for an eligible small business, this does not include governmental entities or tax exempt entities, as well as it doesn't cover owner-only plans since no NHCs are covered. What are qualified startup costs? These are ordinary and necessary costs that a small business incurs in order to set up and administer a qualified retirement plan, as well as those costs to educate employees about the plan. The qualified retirement plan include 401ks, SEPs, and simple IRAs. 403B is not considered a qualified retirement plan under this tax credit. Also, adding a 401k feature to an existing profit sharing plan does not qualify as a startup cost. Now, the amount of the startup tax credit. Before the Secure Act, the qualified startup cost tax credit was equal to 50% of eligible startup costs up to $500, up to a $500 limit. Under the Secure Act, that has increased. The credit is 50% of eligible startup costs up to the greater of $500 or the lesser of $250 multiplied by the number of NHCEs who are eligible to participate in the plan, or $5,000. We're going to get into a couple examples of that as it is kind of a complicated calculation. Employers may not deduct the startup costs as well as claim the credit for the same expense, meaning if you have a $2,000 startup costs and you're able to claim a credit of $1,000, you're not able to deduct the entire $2,000. You'd only be able to deduct that excess $1,000. It's also important to note this is a non-refundable tax credit. This startup tax credit is claimed on IRS Form 8881, and it's just filed in conjunction with the employer's tax return. The eligible tax years for this tax credit are for tax years beginning after December 31st, 2019. Employers may claim the credit for each of the first 3 years of the plan. And employers can choose to start claiming the credit in the tax year before the tax year in which the plan becomes effective. So for example, if next month you have a client that puts in a plan on December 1st, but their plan will be effective for January 2020. They've incurred expense in 2021. The company can claim the tax credit on their 2021 return. So the second tax credit we're going to talk about is the automatic enrollment tax credit. To be an eligible employer for this, there are 2 requirements to be met. They have to have 100 or fewer employees who are paid at least $5,000 in compensation by the employer in the preceding year. And they have to have added an automatic enrollment feature to a new or existing plan. As you can see, there's no non-highly compensated employee requirements. Also, this is not available for governmental or tax-exempt entities. Further, last year, the IRS released Notice 2020-68, where it stated that employers participating in a multiple employer plan whose participants are subject to an eligible automatic contribution arrangement, also known as an EACA, are eligible for the tax credit. So this clarified, so even if the plan was in existence prior to the plan sponsor adopting this multiple employer plan, they would be eligible for the tax credit. Now, the amount of the automatic enrollment tax credit is a credit of $500, regardless of whether it even costs $500 for implementation. It's available up to 3 years. And similar to the startup tax credit, there's no deduction for costs covered by the credit, but you can deduct costs not covered by the credit. Now, a little bit more specific about the automatic enrollment feature. There are just basic automatic contribution arrangements. This, in order to qualify for the tax credit, it has to meet either the eligible automatic contribution arrangement, or EACA, or qualified automatic contribution arrangement. So for an EACA, it must be in place for the 12-month period. It must be put in place prior to the beginning of the year, and there is a reasonable notice, an EACA notice, that must be given to participants. The exception to that prior to the beginning of the year is if there's a new plan established mid-year, or if they're adding a 401k feature mid-year. There must have a uniform automatic deferral percentage, as well as there's a feature called permissive withdrawals, which can be allowed, which would give participants the opportunity to take their money out after a period designated in the plan document, usually 90 days, if they decided they don't want to be automatically enrolled. It's not required to be in there though. For a QACA, this must be in place also for a 12-month period. It must be put in place prior to the beginning of the year with a reasonable notice. The initial automatic employee contribution must be at least 3%, with an automatic escalation of contributions by 1% each year. So by the 4th year, the automatic contributions are at 6% of compensation. The maximum automatic employee contribution for the first year is 10% of compensation. And in subsequent years, it can't exceed 15% of compensation. Further, for a QACA, the employer would make contributions similar to safe harbor contributions. The first is either a match or there's a non-elective contribution. The matching contribution is 100% of deferrals up to 1% of compensation, and 50% of deferrals from 1 to 6% of compensation, or the non-elective 3% compensation. So you'll see that the match is actually a little bit lower than the standard safe harbor matching contribution. Further, a little bit different is that employees are not immediately vested. They must be vested in the employer matching or non-elective contributions by 2 years of service. So unlike the ordinary safe harbor contributions that are immediately vested, these are vested at least after 2 years. The safe harbor provisions apply so that the plan would be exempt from annual non-discrimination testing, which is another bonus. So here are some examples of the tax credits. So say in 2021, you have a plan that put in an automatic enrollment provision. They have 10 non-highly compensated employees. They have a setup and admin fee paid by the company of $2,000, which gives them a $1,000 startup credit, a $500 enrollment credit, which would leave $500 tax deductible setup and admin fees. And in the following year, they still have that automatic enrollment feature. They have now 20 non-highly compensated employees. The fees for that year came in at $3,000, which would give them a startup credit of $1,500. They still get that automatic enrollment credit of $500, which would leave $1,000 in tax deductible fees. And in the following year, 2023, they still have that automatic enrollment feature. They've moved up to 30 non-highly compensated employees. The fees during that year are $4,000, which 50% would give you a $2,000 startup credit. They still get that same $500 and automatic enrollment credit, leaving $1,500 in tax deductible fees. Here's another example. An employer sets up a plan with 75 non-highly compensated employees. During year one, the employer incurs $12,500 in startup costs. The number of NHCEs increased to 105 in year two, and the startup costs reached $14,500. How much is the tax credit in this example? So as you can see, we multiplied the number of non-highly compensated employees by $250 in each year at a maximum of $5,000. The startup costs were $12,500. 50% in that first year is $6,250, and that second year is $7,250. The answer is $5,000. So even though the employer has 75 non-highlies, the startup credit is capped at $5,000 in each year. Further, in the second year, the employer moved up to over 105 non-highlies. So the employer would no longer be eligible for that small business tax credit. Another tax credit that I wanted to touch on that is not very well known is called the Retirement Savers Credit. I realize it might not be applicable to many of your clients, but I think it's something that's important just to have under your belt. It's up to 50% tax credit for eligible contributions to an IRA or employer-sponsored retirement plan. Now, if you take a look at these brackets, it is based on income. For 50% of your contribution, if you have no more of an AGI than 39,500, married filing jointly, head of household is 29,625, and not more than 19,750 if you are single, married filing separately, or qualifying widow or widower. And the percentage of the tax credit goes down as income increases. The maximum contribution credit is $2,000 for single filers with a maximum credit of $1,000 because it's 50%, and $4,000 for married filing jointly with a maximum credit of $2,000. In order to be eligible, you have to be 18 or older. You must not be a student and not claimed as a dependent on another person's return. Contributions include contributions made to a traditional or Roth IRA, salary deferrals to a 401k, 403b, governmental 457b, SARSEP, or simple plan. And it also includes voluntary after-tax contributions to a qualified retirement plan or 403b plan. So another thing I wanted to touch on was some legislation that is working its way through Congress. They're calling it Secure Act 2.0 because it is additionally going to have sweeping changes to our industry. Will it pass? What will the changes be? Are yet to be seen. But here are some important things I wanted to note because they do relate to the tax credits we talked about today. The first is that it would increase the small business tax credit to 100%, up from 50%. The increase applies to employers with up to 50 employees. So it is giving a bigger tax credit to those smaller entities. Additionally, it would give another credit in the amount of a percentage of the amount contributed by the employer on behalf of the employees up to $1,000 per employee. So it would be 100% in the first and second years of the plan, 75% in the third year, 50% in the fourth, and 25% in the fifth. The full credit would be given to those employers with 50 or fewer employees, and then it's phased out for those employers between 51 and 100. And this would be effective for tax years beginning after 2021. Additionally, it would apply the tax credit for a business that joins a multiple employer plan. So if the employer that would qualify, an eligible small business, joins a multiple employer plan, they would be eligible for the tax credit, the startup tax credit. Also, regarding the retirement savings tax credit, previous version of the bill increased this to 100%, up from 50. A subsequent version only included efforts to promote this credit since it's rarely used and not fairly well known. Some other tax credits, one other one is a military spouse retirement tax credit. This is a new credit that would be for small employers that employ military spouses and allow them to participate in the employer defined contribution plan. This is a credit up to $250 per employee, plus $250 for contributions made by the employer up to 3 years. Some other notable provisions, and I know some of these are going to be covered in later sessions, but I just want to touch on them. It's unclear if this is going to have an effect on the automatic enrollment tax credit, but there would be a mandatory automatic enrollment feature for defined contribution plans. This would apply to new plans and all newly eligible employees. So it wouldn't necessarily apply to plans that are in existence. It would require a default rate of at least 3% with automatic escalation of 1% per year. And another interesting provision is that there would be a new catch-up contribution limit for 401k plans. For those individuals between age 62 and 64, it would increase the catch-up contribution up to $10,000. Currently, I believe it stands at $6,500. So just for individuals in that age bracket would have a bump up. Also, the Secure Act brought into light the term long-term part-time employees. I know there's a session later this week on that subject. This allows people who work for an employer for at least 3 years with 500 hours or more to be eligible for their defined contribution plan. They must be eligible to make elected deferrals. This act would change that provision from 3 years down to 2 years of service. There's also discussion of increasing the required minimum distribution age up to age 73 in 2022, up to 74 in 2029, and up to 75 in 2032. There's also a provision regarding student loan match. This would allow employers to match employees based on student loan payments rather than elected deferrals. Also, there's a provision that would allow retroactive first-year elected deferrals for sole proprietors or single member LLCs. So this would allow 401k contributions to be made after the end of the plan year, as long as they're made by their tax filing deadline. And I know that we had some discussion earlier about putting in plans for a prior plan year under the Secure Act. So this would be addressing that issue. There also may be changes to the family attribution rules, which would potentially eliminate spousal attribution, meaning there's a lot of limitations on whether a husband and wife or a couple can put in each a plan on their own because they're attributed to each other's stock. This would potentially eliminate those rules that would attribute them to each other. Also, there is discussion of allowing SEP and simple IRAs to treat contributions as Roth contributions. And finally, there is simply an effort to simplify reporting and disclosure requirements, specifically removing requirements to notify unenrolled employees. And I think we can all appreciate that. We have some great resources on definity.com. There's some worksheets about how to use the tax credit, as well as, I and my team, we work on at least quarterly newsletters in ERISA Connection regarding current topics, topics we're finding that a lot of plan sponsors or advisors are asking about. We try to make those relevant and hopefully are helpful to, you as an advisor or plan sponsors to navigate what's currently going on in our industry. I don't see that we have any questions. So,
Carolyn, maybe I could interject. Thank you for
sure.
some tremendous information. I wrote down a lot. Realize is a little bit too nerdy on the ERISA side, but there was a lot in that. What I think is interesting, these are just some observations. If the tax credit is so focused, on these new plans, but it's exclusive to build costs to the company, 5-10 years ago, my experience was, okay, I want a startup plan. There's minimal cost to the company, but boy, are the costs, the asset fees, investment fees are loaded up on the participant. We do seem to be shifting, and it seems like if we get more credits in the future, it really should take the burden off of the employees to bear that cost and make the company more willing. This would be a shameless plug, but in some of your examples where, we've got a 30, 50, 70 person company, they're going to get tax credits that cover up to, $10,000 of eligible cost. Well, most plans don't, most costs for plans are not that high. So I'm thinking there's a lot of scenarios where there's essentially unused credits for at least 3 years. And I want to encourage those who can in the advisory community, consider charging, a one-time setup fee. Consider utilizing, a flat annual fee for service, $2,000. Because while, most arrangements are potentially 50 basis points, you're doing a lot of work for 50 basis points of nothing, unless we have significant rollover. So I do think we probably need to just consider how we're structuring our costs a little bit more as we see the shifting landscape of these credits. And then shameless plug, as a third party administrator that also does 316 fiduciary services, if this is a new plan that maybe not they're not completely ready to take on the burden to operate the plan as a fiduciary, potentially consider outsourcing that. If the 316 quote is $2,600, well, if we've got available tax credits, that's really only $1,300, and that can take a lot of burden off of probably an already strained, HR and finance department. So anyway, thanks for letting me jump in at the end of that. I thought that was fantastic.
Thank you.